As the S&P 500 reaches a new high, the question is this a bull market? Hello and welcome back to our channel. My name is Daniela. And in today's video, we will be reviewing the performance of the S&P 500, as I just mentioned, reached a new all-time high last week, and it's attempting to push that higher even further this week. But before we get into it, please like this video, comment, subscribe, and turn on your notifications to be kept up to date. And as always, if you have any questions about the markets or trading in general, feel free to leave them in the comment section and we'll try and get back to you as quickly as possible. So the S&P 500 reaching a new all-time high on Friday. The last time it pushed a new all-time high was in January 2022. Now, if we review the conditions between now and what was happening back then, a lot has changed. Most notably, rates are much higher at current times. And also there's a greater risk of recession. There are concerns about growth, about how economies are going to evolve over the next 12 months, and whether monetary policy will be adapted as such now that inflation seems to have come somewhat under control. But in general, compared to January 2022, so 2 years ago, a lot has changed and not necessarily in favor of the stock market. So that does bring a lot of question as to why we are currently pushing a new all-time high in the S&P 500, but also other stock indices like the NASDAQ, like the Dow Jones, European ones as well, like the DAX 40 and the FTSE 100, also following closely and turning that momentum higher once again after a little bit of a rocky start to 2024. Now, a lot of people are saying that there's limited breadth in this rally. There has been for the last 2 months. Remember, we saw that sharp reversal higher in November as markets started to price in rate cuts from key central banks. But a lot of that move has come from the Magnificent Seven, those big tech stocks that have been making the headlines recently. If we look at an equal weighted S&P 500 index, we do actually see that it hasn't reached a new all-time high. So it is below what the actual index is performing. But nonetheless, we have seen some good momentum throughout the general stock market. NVIDIA, which is the AI chip maker, has been the best performer, or has been the main contributor to this rally in the S&P 500. But actually, the sector that has performed the best has been energy. So we do see that the tech sector has been dominating, but also it has spread out to other sectors as well. It's not just the Magnificent Seven that are dragging this rally along. We do see a more wider breadth in the market than what some are anticipating. So there is some justification for this wider spread rally in the stock market. But the key question is this a bull rally? Is this a bull market? Is this a continuation of the pattern? Are we going to see higher highs continue? Some are actually pointing out that this bears some resemblance to what we saw in 2007 prior to the 2008 financial crisis. We did see new all-time highs there. We did see pushing the boundaries prior to the crash. And a lot, as I said, there is some reference to make here that resembles the situation back then. I think a lot of it is going to have to do with the bond market. I think bond yields are going to be key drivers of the momentum. And I think it's going to be one of those economic playoffs between investing in stocks or investing in bonds, and which one is more economically sensitive. And I think which one's going to offer investors the greater return. If we're looking at the bond market, I think it kind of gives us an indication that this really isn't a bull market, that things could change pretty quickly. And I think that's the key conclusions can be driven comparing earnings yields and bond yields. And I think bond yields are still more attractive than earnings yields. I think looking at these measures, and especially if we expect the yields to consolidate around current levels, I think it makes it hard to justify the valuations that we currently have in the stock market. So I think that does put a little bit of a spanner in the works of those that are optimistic that the stock market is going to continue pushing higher, whether that be justified by a soft landing, whether that is because the Federal Reserve has actually pivoted and we are going to see cutting rates from here on out. Of course, the data is going to be crucial. And the fact that we have seen better than expected data has been driving equity markets But also it's a double-edged sword because better data is good for equity markets because it means the economy is resilient and therefore earnings are expected to remain high in the future. But as we know, it's also permitted the monetary policy from central banks to remain tight, to remain restrictive, and that has weighed on stocks. So it's kind of hard right now to know how to read data, and especially better than expected data. We have seen, of course, CPI pick up in December, and that did weigh on stocks slightly, but it was only marginal. As I said, we've seen the stock market recover some of that momentum in the last week. So it is quite hard to determine short-term direction. I think a lot of it is going to have to do, as I said, with the bond market and how bonds perform. So far, they look more attractive than stocks, and that could start to weigh on the stock market at some point in the near future. Of course, monetary policy is going to be a big one for that and how that affects the bond market as well. But for now, as I said, it is drawing resemblance to that 2007 peak where it was reaching those dot-com bubble highs. So yeah, all-time high for the S&P 500. Let's just see whether that can be followed through even higher. Let's quickly jump onto the chart now to review it. So here we have the S&P 500. I have marked on the chart some key events that have happened, most notably the FOMC meetings and the US CPI data that have come out. You can see the latest reading that we had coming up at 3.4%. That was a higher than expected rise. As you can see, weighing a little bit of momentum there throughout the week, but nonetheless seeing that strong reversal higher. As I said, those all-time highs pushing above the highs that we saw back here in January 2022. So as I said, it looks like that positivity has returned to markets. But if we're looking at the RSI, we are once again breaching that overbought area. We know we can push it. We've seen it in the past back here in December before that Fed meeting in mid-December. We did see the RSI pushing all the way to the 80 mark. So there is a way to go before we may see sellers piling into the market. But as I said, a lot of it is going to have to do with the bond market and how attractive stocks can be seen as compared to bond. Because realistically, why would you want to take on the added risk of the stock market if you can get the same or better return from yields? And usually, if yields on the bonds are a particular level, you would expect stocks to be discounted to that level to compensate for the extra risk. So the way yields have been holding and consolidating does suggest that stock prices will have to come down at some point. And that is essentially what has been potentially holding on to some of that sentiment. And people may be looking to kind of find that short-term top and be able to come into a bear market retracement. But nonetheless, that momentum towards the top side right now, as I said, the RSI just grazing that 70 line, potentially looking to move even further before really considering how much follow through this rally actually has. That is it for today's look at the S&P 500. Thank you so much for watching, and don't forget to subscribe to our channel.